Personal Finance Practice Problem using OneNote. Financial Statements and Budget Part 2. Income Statement. Prepare to get financially fit by practicing personal finance. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon on the left-hand side in the Practice Problems tab down in the 2301 Financial Statement and Budget Part 2 Income Statement tab. Also note, when using OneNote, take a look at the Immersive Reader tool. Our practice problems will also be in the text area. Same name, same number, but with transcripts. Transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, we got our information up top, calculation on down below. We're putting together our financial statements, and then after that, using that to put together our budget. Last presentation, we put together our balance sheet from our data on the left-hand side, balance sheet on the right, which we put together last time. That includes the assets, the liabilities, assets minus the liabilities, giving us then that net worth, remembering that the balance sheet represents where we stand at a certain point in time. In this case, we're talking about basically the end of the month or the end of the year, typically the end of the month here, and we've got this $3,300 of the net worth. Now, the next statement, the income statement, is the story. It's the action. It's what's happened in order to get us from the last period to this period. So if we think of the last period, if, for example, we had a net worth last month of $2,000, and now we have a net worth of the $3,300, then the difference would be, you would expect, the income. The income would be the story to get us from one period to the next. Now remember that if you're using a full service double entry accounting system, then that'll be an exact difference, because when you enter the information into something like a QuickBooks or a transaction by transaction basis, you're constructing the financial statements from each transactions, and therefore they will tie together nicely, and you'll have to deal with any accrual kind of cash differences as you do the data input. However, if you're compiling this information just from the financial statements that you're receiving, your statements from your bank and your financial institutions, or compiling it with software in that format, then the balance sheet will be fairly easy to come by, typically calculated by taking the assets minus the liabilities. But it's not so easy to kind of tie it out to the income statement, because you're going to have to take then the data for the income statement, which may include the activity in your checking account, and compile it into your accounts so that you can come up with the income statement. It might not line up exactly to the net worth from one period to the next, because you haven't exactly used the double entry accounting system and accounted for exactly the differences between a cash basis and an accrual basis, meaning you might be using some accrual concepts basically on the balance sheet and some cash concepts on the income statement, not quite lining them up, and that would result in the difference. If you were to reconcile those two, it would all tie out, but just realize you have to have the pros and cons in terms of how much time you want to spend on this in your particular situation. So the data's on the left-hand side. We're now going to be on the income statement information, which is straight down below. The typical income statement will simply have a one-step income statement, which will usually have just simply income and then expenses. Income usually doesn't have a whole lot of line items, because you usually only do one or two things to generate income, and then everything else you buy, and therefore everything else on the expense side, you can have a lot of categories on the expenses, but hopefully the dollar amount for all of those categories on the expenses will be less than the dollar amount on the income. Also note that the expenses are usually the most complex portion, and they vary often the most out of all categories on the financial statements from what you might see in a business setting. There is less standardization with the personal finances, so you have a lot of leeway down here to try to figure out what groupings will be best. General idea that you want to keep in mind is that, first, do you want to have a lot of detail in your accounts or a little bit of detail? The trade-off between a lot of detail and a little bit of detail is that the more detail you have, the more it might tell you about particular things. For example, you might break out your restaurant information by your sit-down restaurants, your fast food restaurants, your groceries and whatnot, or you might just call it food. So, and then you can put everything in one place. If you break it out in a lot of detail, your income statement's going to get longer, and you might have subcategories that you would include in there. If you have less detail, It'll be easier, but you will have less information that will kind of be broken out in the details. So that's going to be your trade-offs that you're going to be putting in place. Many people will have standard kind of things down here like rent, the utilities, cable, and whatnot. But many things might differ for an individual, such as your preferences for things, especially on the personal kind of expenditure side. Like if you go to, what kind of entertainment you have. Do you want to break out your entertainment in different ways and whatnot so that you could track how much you're spending on particular types of entertainment? And so those would be the decisions that you would want to consider. So let's start to put this thing together. We're going to start out with the net monthly income. And we're going to start out with the income at the $3,200. So notice what we have over here is we've got the gross monthly income and the net monthly income. So that's your choice on the income side of things. If you are a W-2 employee, do you want to put your income on the books gross or net? If you're taking gross, you're taking it from your paycheck stub, taking the gross amount, even though that's not what actually hit your checking account, because your employer had to take out at least the payroll taxes, which is going to be Social Security, Medicare, federal income taxes out of the pay, and possibly benefits, including 401k plan or, health insurance and things like that. Or you could just say, hey, look, I'm just going to start my income statement on a cash basis for what I actually receive. And it just depends on what your purpose is as to which one you would want to do. That's what we did here. We're saying this is the amount that hit the checking account. So I'm going to use that amount instead of using the gross amount. If you used the gross amount, you can record the income at gross, and then you'd have to look at your paycheck stub to see what the difference is, what your employer took out of your pay directly, and record, in essence, an expense usually for that difference, which would include things like the payroll taxes, both of those things, in essence, happening at the same time. Then we got the cash outflows. We're going to, in essence, be on a cash basis here. We got the fixed outflows. Note that we're going to be breaking this also this time out into the behavior of the income statement accounts. This is another choice that you may want to do and may want to consider. And note, in financial accounting for a business, especially for a manufacturing business, a business that makes things, oftentimes we have different rules for what we have to do for the financial statements and what we might want to do internally for like budgeting purposes. So for the financial statements, oftentimes we have, a categorization of the expenses by what they're used for, which is our traditional way, rent, electricity, and so on. And then when we think about our budgeting, we might want to break out our categories in terms of the behavior of the expenses. And that might be the fixed outflows and the variable expenses. And those things are used that way because the fixed items are things that are not going to change with the level of production, meaning in this case, like if our income went up, the rent will not change because we've already signed the lease, so it's going to be the same. And in this case, for the personal side of things, you might want to think about it as the fixed items as things that are set. They are what they are. You don't have control over them. And then the variable items are things that you have more control over. So that's another way that you might format your income statement so that you can budget more easily, focusing in on those things that you have control over. So we have the fixed outflows. That's going to be the $420 at the rent. We would expect that to be the same each time period. We've got the credit card payment. That's going to be the $165. Note that the credit card payment is something that on a cash basis would be coming out of our monthly income. So we might see it as, from a cash flow basis, a decrease on the income. But if we're on that accrual kind of component or recording this into accounting software, there's going to be a portion of the payment that's going to decrease the loan amount, the liability on the books, and a portion that would be just expense on the income statement. So that's one of those differences that you got to keep into consideration when you're deciding how exactly you're going to be putting this together and what's the purpose of the statements that you are putting together. Also note that you would be getting this information from the bank statement, most likely your activity. So when you paid the rent, you saw it come out of the checking account. When you got the credit card, you see that coming out of the checking account. If you were using something like QuickBooks, a full-service double-entry accounting system, you would record these as you go. Obviously, if you're constructing the income statement, then from scratch or just by hand using Excel or something like that, you would see these coming out of your bank account and start to compile them into their categories. Clearly, the rent would go to your landlord, so whoever the vendor is would be the landlord. The credit card payment might be to like Visa or American Express and so on. The car insurance, so we're going to say that that's also going to be something that's fixed. It's going to be standardized from month to month. Note that insurance is something that you actually pay before you get the insurance, the coverage, which means from an accrual standpoint, if you do an account, then it might be something that you have a prepayment for. If you only pay it monthly, it's not a big problem to just be on a cash basis. But if you pay for an entire year's, for example, worth of car insurance in January, for example, because it's cheaper to do so, then you've got this situation where if you're on a cash basis, you will have this giant expense in January, which will not be there in February, even though you consumed the car insurance in February. You just paid for it in January, resulting in the comparison of month over month to be kind of distorted. You got to keep that in mind when in that kind of situation. That's why we do accrual accounting with a prepayment if we were to do accrual accounting. So if you're not doing accrual accounting and you're using a cash basis and you're making comparisons month over month, then those kind of things you want to keep in mind. Did I pay for something that's affecting multiple months that I'm writing off in the current month? And if so, how does that affect my performance measures when I'm comparing, say, January to February? That gives us our total fixed outflows, the 420 plus the 165 plus the 210, which we put in the enter column. Notice we're getting a little bit more complex in our structure. We got the cash outflows and then a subcategory, one of two subcategories, and then another indentation here for that subcategory, it then being in the outer column or middle column for the subtotal at the 795, summing up these three numbers. Then we've got the variable outflows. When we think about variable costs, this is traditionally in a manufacturing company, a variable cost would go up with the level of production. So for example, if we had a hamburger shop and we were making hamburgers, the variable cost would be the things like the meat, the buns, the lettuce and whatnot that we would try to be able to break down as much as possible on a per burger basis so that we can see them going up in proportion to our sales and our purchases. Obviously, we can't do that one-to-one relationship here, but what we can do is think about the variable costs as things that might change as our income goes up. So typically, as income goes up, we'll spend more. And you might also think about this as the items that you have more control over than the fixed costs. The fixed costs, we're saying those are pretty much, they are what they are. The variable costs we have some control over. Note that most variable costs are probably more like fixed or mixed costs, meaning they have a variable component and a fixed component, meaning there's a baseline that we're probably going to have to end up paying. Over and above that, we might have the variable side to it where we have some control over it given the behavior that we have over the time period. But, we're probably just going to have all mixed and variable costs down here in the variable component. These are the items typically that we want to focus on because we generally have more control over them when we do the budgeting. So we have the food. So we picked up the food down here. That's a general category that's a personal choice to call it food. It might be equivalent to meals and entertainment or just meals possibly on a business side of things. But again, it's an area that you might be breaking out into separate categories so that you can track different places where you're spending your money on food. Shopping, that's clearly going to be something that's going to be on the personal side. It wouldn't be on a business. You wouldn't just categorize it as shopping. But when you're thinking about, I'm thinking shopping here, like your general shopping, possibly your frivolous type of shopping, right? Things that could be categorized in there. Clearly, if you have personal items that you're buying, if you're buying just random things that you just, they don't fit in any type of category, maybe it would be randomly under shopping, or maybe you would want to classify it in more depth. I mean, you might classify things for gifts, like Christmas gifts or other gifts or birthday gifts, and see how much you're paying on that kind of stuff as well, and break that out separately from your shopping on just random things, shopping for personal things, shopping for family things. So there's a whole lot of different groups that you could break out that you wouldn't have on a business side, but which might be relevant to a personal side. Electricity, so that clearly would be fairly straightforward on the utilities. Note that you might group things together in utilities like the electricity and like sometimes even the phone or the gas. But oftentimes it's useful to break them out separately so you can track them separately. Also note that something like electricity will typically have a mixed component to it, meaning there's probably a baseline of electricity that it is what it is. And then anything above that, maybe you have some control over based on your behavior, how much you turn on the air conditioning and so on. Clearly, also note that when you compile this data, if you're compiling this, it would be money going out of your checking account. The food would be going to restaurants or something like that as the vendor, so you'd have to add them up. The shopping might be going to whatever store, Amazon or something like that, so you'd have to add the expenditures out for the month. To get there, the electricity would be going to, of course, your utility company. Usually there'd only be one payment per month there, so that would be pretty easy to do. The water, same kind of thing, probably more like a mixed cost where you have some control over a certain threshold, and then it would be going to the vendor or the water company. The cable bill, the cable's something that once you're committed to, like if you're saying, I'm not going to cut the cable, it is what it is, it might be up here more on the fixed side of things because you would expect the cable bill to be the same from period to period. It doesn't increase or decrease with your consumption. So you might not consider it variable if you're committed to keeping the cable. It's basically whether you want to have it or not. Now, if you have some kind of cable service, which might be more likely these days, they're starting to have these things where, you know, if you watch more, you pay more, and you watch less. So then your behavior has an influence over how much you pay. Then that would be more of a variable type of thing. The car expense, the auto expense. So this is something that you'd have to find by looking most likely at the gas stations and whatnot that you'd be paying for the automobile and any kind of maintenance as the vendors that you would have. It also probably has a baseline amount that you would say this is mandatory for me to get to work at least. And then anything up above that then might be variable in that it depends on your behavior for personal expenditures after that point. We have the entertainment. Note that we put down here concerts and movies adding up to that entertainment. Now, the entertainment is an area, if you're looking at business, we just put something in entertainment or possibly even meals and entertainment. But a lot of times they break it out now because for taxes it might have changed. But in any case, it would be one category generally. But you might, if it's entertainment's a big category for you and you want to, that's where you have a lot of control to see what your behavior is and try to think about where do I want to get my maximum benefit enjoyment out of where I spend my entertainment dollars. You might break them out between concerts and movies and whatever else you spend entertainment on so that you can track it and say, is it worth it to go here versus there? You know, taking into consideration the cost, where would I get the most fun for my money might be worthwhile to do there. So in any case, that's going to give us the total variable outflows. We've got this inner column summing it out into the outer column here. Now we have these two amounts in this outer column, the total fixed outflows and the variable outflows, which we can then total up in this column all the way to the outside. Note this looks complex if you were just to look at it without kind of knowing the convention. But notice here, if you know the convention, it's not too bad, right? We're only summing up one column at a time. We got this column is summed up over here. This is only summing up this column to the left, and this number is not going to be jumping all the way over here to a column that's not even next to. It's only going to be doing something either in the column straight above it or the one immediately to the left of it. There is nothing straight above it. Therefore, it's going to be adding up or subtracting these ones to the left. It's going to be, in this case, adding them up. The 795 and the 1,920 giving us the 2,715. Then we can calculate the net income, which would be the 3,200, which was the monthly income minus the 2,715 total outflows, in essence, expenses, to give us the 485. Notice again, we're only doing something in one column at a time. I'm in this column down here, that 485 has something right above it. So I'm not going to be jumping then to the left. I'm just going to be staying in this outer column. In this case, a subtraction problem in the outer column. Then we've got the 485 excess, and we're going to say that we're going to put 285 we've committed to putting into savings. 285 we committed to, and then we had the other savings account of the 130. So we're putting 285 and 130 into savings, which gives us a surplus after the savings of the 70. Notice that if we're committed to these savings down here, you could think of them as a cash outflow and kind of like a fixed cost in essence, if you're thinking you're automatically going to put so much into a savings account. But there's something that's going to be a cash decrease from your spending cash, but they're going to go into an asset account, and that's going to be your savings account. And therefore, you might want to break them out down here to kind of indicate that, right? You got this amount that would be your net, and then you're going to be taking out your savings that are going to be a fixed amount, and now you have this net surplus of the 70 that you could do whatever you want, would be save into the checking account or put into savings as well. So next time we'll go into the budget component of our problem, noting that when we're thinking about the budgeting, usually we're thinking about the income statement type of things. That's the timing statement. So when I'm trying to think about what's going to happen next time period, how can I change my behavior? What can I do about my performance? I'm comparing my performance last month, which is the income statement, to what I'm going to try to do next month, and that's what the budget will be.